Welcome in this second lesson of Introduction to Financial Accounting. And in this lesson, we are going to tackle the accounting equation, the accounting standard, difference between accounting standard and accounting policies, objectives of setting accounting standard, importance of accounting standard, limitations of accounting standard, and professional ethics in accounting. So kindly subscribe and get free summarized financial accounting notes and answers to custom past paper questions from 2015 to 2023. You can contact us through the email samuelgetudu20@gmail.com or samuelgetudu19@gmail.com to get those resources so that you can start preparing RA for exams and also practicing questions. Now, let us first start with the accounting equation. And we usually say that the accounting equation is the most basic thing that every accountant must know. And the accounting equation is very simple because it is just that assets, accounting equation is say that assets equals liabilities plus capital. Your assets must always be equal to your liabilities plus capital. Why is this the case? This is because of how a business is financed. For example, if a person wants to start a business, then he must have capital because that capital, if it is cash, if he have he want to start a business and he have 100,000 which he want to start the business with. So that 100,000 is the capital, and that cash is also the asset. So in that case, you can see that if you have zero liabilities, then you can see that the total of assets will equals to the total of liabilities plus capital. If you want to start the same business with 100,000, but he only have 50,000, and the business, the assets which are required in that business so that it can be started and be learned smoothly is 100,000, then it means that he have to look for the 50,000 that he requires. So he can get a loan from friend. And since that loan is going to be repaid, so that is a liability. So if he uses the total 100,000 to buy assets, then he have uh, the capital of 50,000 cash, which is asset, and a loan of 50,000 cash, which is liabilities. So that is why you are seeing that asset is equals to liabilities plus capital. So what are assets? What are assets? And we usually say that assets are resources owned or controlled by a business for future benefits to the business. Assets are resources owned or controlled by a business for future benefits to the business. And examples of assets, they include cash. If a business owns cash, then that cash is for the benefit of the business, because the business can use that cash to purchase more stock, to sell those stock and make profit. The business can use that cash to pay its employees. The business can use that cash to generate more cash. That is why we are saying that assets are for future economic benefit to the business. Another example of asset are trade receivable. Receivables, these are debts that are owed to the business. If the business have sold it is inventory on credit, it means that they are trade receivables. The debtors will pay those debts in future. Therefore, the business is going to receive money in future due to on the account of having trade receivable. Then there's building, the building in which the business is being carried out. That is another example of an asset. We have motor vehicles. These are motor vehicles in a business which are used for distribution purposes. They can be used for also other purposes. They can be used to distribute goods to the warehouses. They can be used to distribute goods to the retail shop. These motor vehicles they are assets of a business. Then we have prepaid expenses. Prepaid expenses are expenses which are paid for future accounting period. For example, we have rent as an expense. If the rent for one accounting period, that is for a whole year, is 100,000, but you as a business as the owner of the business, you pay 120,000. It means that that 20,000 is for the next accounting periods. Therefore, that extra 20,000 is a prepaid expense. And then we also have other assets. We have other assets. We're going to discuss assets, about more assets in the second topic. Then you have liabilities. What are liabilities? Liabilities are creditors' claim on the business or the amount that business owes to other business or individual. Liabilities are obligations that the business is supposed to pay. The obligations that the business owes to it owes to other businesses or other individual. Examples of liabilities, they include bank loans. If you have been given a loan by the bank, it means that you are going to pay that loan in future. Therefore, that is a liability. Another example is trade payable. If the supplier has supplied the business with goods on credit terms, then the business is supposed to pay for those goods in future. Therefore, that is a liability. Then we have personal loans. If you have been given a loan by your friends, your relatives, and they expect you to pay that loan in future, that is also a liability. Therefore, are liabilities are the amount that business owes to other individuals or other businesses. Then we have the capital, and the capital represent the portion of the business asset that shareholders or partners own. Example of capital include owner's capital, owner's withdraw, and profit. The capital, we are saying that if you have these assets, if you take liabilities to the other side, then you have asset minus liability equals to capital. Therefore, capital is the portion of the assets that remains after you have deducted all your liabilities. Capital is the portion of the assets that remain after you have deducted all your liabilities. And also, capital can also be defined as the amount, the portion that you as the owner you contribute to add starting your own business. Then we go to the second objectives. We go to the second objective, which is the accounting standard. The accounting standard. And we should say that what are accounting standard? When you are conducting accounting, there are some standard that you are required to follow. So accounting standards are a set of guidelines and procedure that are used when accounting for the affairs of most government. When we talk about government, we are talking about public sectors, public institutions. These are public organizations, those which are run by the government. They can be the national government or uh, local government or county government. Then we have the non-governmental bodies and non-governmental bodies. Now, when you're talking about non-governmental bodies, we are talking about all other businesses apart from apart from uh, government run business. So non-governmental bodies, this they include private companies, sole proprietorship. Then we have partnerships. Those are some of the examples of non-governmental bodies. So accounting standards are a set of guidelines and procedures that are used when accounting for the affairs of government and non-governmental bodies. So we also say that they exist to ensure that accounting decisions are made in a unified and reasonable way. So this accounting standard, uh, they exist to ensure that all the businesses they are accounting for transaction of the same nature or transactions which are similar in the same way, in a unified way, so that we don't have this uh, business accounting for for a transaction in a different way from what another business is accounting for the same transaction. Then we say that the accounting standard they must fulfill two criteria as follows. They must provide generally understood and accepted measure of the phenomena of concern. And then number two, they should significantly reduce the amount of manipulation of reported numbers which is likely to occur in the absence of the standard. So we are saying that an accounting standard, for it to qualify to be called an accounting standard and to achieve the objectives that accounting standards are intended to achieve, then they must provide a generally understood and accepted measure of the phenomena of concern. Therefore, when we are talking about a phenomenon of concern, we are simply talking about a transaction. So, for example, an example of an accounting standard is the International Accounting Standard 2, which directs how to measure inventory. Accounting Standard 2 directs how to measure inventory, and it states that inventories must be measured at the row of cost or the net realizable value. Inventory must be measured at the row of cost or the net realizable value. So if by that accounting standard being there, all the accountant understand when they go into a business and they are told to measure the inventory, they understand that those inventory are going to be measured at their cost or their net realizable value. Then, by that accounting standard to existing and other accounting standard, they significantly reduce the amount of manipulation of reported numbers, which is likely to occur in the absence of the standard. Because a standard is there, then that is what all the accountants must follow in accounting for transaction, which we are calling them phenomena of concern. Then we go to the objective number three, uh, where we are going to understand what is the difference between accounting policy and accounting standard. This is a question that is usually tested regularly in financial accounting. Uh, you are told where you are told to state the difference between accounting policy and accounting standard, and we say that accounting policies are specific basis chosen and followed consistently by management as most appropriate to the business, e.g., depreciating asset on straight-line basis, or accounting standard are a large set of quality rules that governs accountants in preparation and presentation of financial statements. Therefore, you understand that accounting policies, these they are specific basis chosen and followed consistently by management, by a management of a certain company. For example, management may decide that we as the management will be going to depreciate our assets on straight line basis, and straight line basis, uh, but when you come to the accounting standard, the accounting standard accepts all the method of depreciation. You can either use straight line basis, you can also use reducing balance method. Therefore, whichever the method management chooses, and it adopts that as an accounting policy. Therefore, we can say that accounting policy, they are within the accounting standard, but they are chosen by specific management or specific companies, and that company follows them consistently. But accounting standard, these are followed by every every accountant, and they govern all the accountants in preparation and presentation of financial statement. Then we go to the we go to the next objective, where we are going to understand the objective of setting accounting standard. Why does those body which are which set the accounting standard, why do they set them? And the number one objective of setting the accounting standard is to bring uniformity in financial reporting and ensure consistency in the data published by enterprises. So, the first objective is to bring uniformity, to ensure that all financial statements that are prepared, they are prepared in a uniform way. Then number two is to help in the solution of accounting conflicts. If an accounting conflict exists, if an accounting conflict exists in an organization, then that organization can be able to refer to the standard guiding the accounting of that kind of a transaction, and the standard will help to resolve that conflict. And the third objective of setting accounting standard is to command a credibility among shareholder, creditors, employees, and public, to command a credibility to command credibility among shareholders, creditors, employees, and public. If shareholder, creditors, employee, and public understand that financial statements have been prepared, and the people in charge of preparing those financial statements have adopted and followed all the accounting standard, then they are able to know that those financial statements are credible, they are dependable, they can depend on them to make decisions. Then we go to the next objective, which is to understand the importance of accounting standard. What are the importance of accounting standard? The first importance is comparability. Comparability. And we say that accounting standard enhance comparability of accounting information between different periods and with other business in the same industry due to the universality they bring to financial record keeping. So this is simply, you can be able to compare financial statement of one period with another period, because all of them were prepared, they were guided by the accounting standard. And number two, you can be able to compare the financial statement of one firm with another firm in the same industry, because you expect that both firm for both firm in the same industry, they will follow the same set of accounting standard. The next importance is transparency. And you see that due to existence of standard, organizations are forced to report the correct financial information without using clever means to hide items or transactions. When the set accounting standard, they bring about a lot of transparency in business, because if business are following those accounting standard, then it is very difficult for business to use clever means to hide transaction. It's very difficult for business to adjust figures in the accounting to hide the transaction if they are using and following all the accounting standard which are set. Then the next importance is relevance, and we say that standards guide organization in generating financial information in the most relevant and reasonable way. And the final importance is when there are standards, the users of accounting information have confidence in examining and making decisions using the reported financial information. Therefore, accounting standard gives the users of the accounting information confidence. They are confident that this information we have been given is true, it is relevant, it is dependable. So they have that confidence as organizations follow the accounting standard. Then, uh, but but despite all these benefits, accounting standards have some limitation. And the first limitation of accounting standard is that it becomes too difficult to recommend an alternative solution to accounting problem where standards exist. If a standard says that this is the way to account for this transaction, then it is very difficult to offer any alternative. For example, the International Accounting Standard 2 says that inventory should be measured at the row of cost or the net realizable value. You cannot offer any other alternative of measuring inventory apart from that as prescribed by that accounting standard. Then the second limitation is there may be a trend towards rigidity and away from flexibility in applying accounting standard. They become rigid. Rigid means they cannot be changed. They cannot be changed. If an accounting standard is applied in this way, then it cannot be changed. And you find that sometimes as the research goes on in the accounting field, there's a need to change uh, some of the way that transactions are treated. And you find that due to the existence of the accounting standard, then you cannot change the way you cannot change the way a transaction is usually treated, because an accounting standard exists and prescribes how to treat that transaction. So even if there's a problem in the way the standard have prescribed the treatment of that transaction, it becomes too difficult to change that. Then the other limitation is that accounting standard cannot override the statute, and they are required to be framed within the ambit of prevailing statutes. For example, you may find that in a country, there is a law which defines how to treat a certain transaction. There's a law which defines how to prepare certain financial statement. So if the accounting standard state otherwise, then there's a conflict. There is a conflict between what the law says, the law is the statute here, and what the accounting standard is saying. And since the accounting standard cannot override that, then that becomes a challenge. So those are the limitation of the accounting standard. Then we go to the final objectives, which is to understand the professional ethics in accounting. Professional ethics in accounting. As an accountant, you're supposed to be professional in your work. So, which are these professional ethics? Which are these behaviors that you're supposed to follow when doing your work as an accountant? The first one is integrity. Integrity. Integrity implies honesty. Integrity implies straightforwardness. Integrity implies a complete total of honesty and straightforwardness in business relations. You must be honest when you are accounting for the affairs of the business. The second professional ethic is objectivity. And you say that accountant, they should disallow bias, conflict of interest, or undue influence from others in their work. You should not be biased, or be you should not accept undue influence when you are doing your work. The you should treat and account for your work as an accountant. You should treat and account for every transaction in the way they are supposed to be accounted for, not the way maybe your boss or maybe other people who have power in the business, they are telling you to account for those transactions. Then the third professional ethic is professional competence and due care. As an accountant must maintain professional knowledge and skill to ensure quality services to client. As an accountant, you must continually learn. If there's a new standard, you must know about it. If there's new rule which affect the accounting, you must know about it. That is what we are calling professional competence and due care, so that you can provide quality services to your client. The final, the not the final, but we are almost going to the final. The next professional ethic is confidentiality. Is confidentiality, and we say that accountant must not disclose financial records to unauthorized persons. You must not disclose financial records to other people who you are not authorized to disclose those financial records too. You must maintain them as you must be able to maintain secrets as as an accountant. And then the final one is professional behavior. And you say that accountant must comply with relevant laws and regulation and avoid any action that discredits the accounting profession. Thank you, thank you, thank you very much.